Welcome to the world of options trading. It's a bit like betting on the future of stock prices. One such bet is called a covered put. Imagine it as a way to potentially make money even when stock prices are flat or slightly dipping. This is done by selling put options, but there's a catch. You need to be prepared to buy the underlying stock if the price falls below a certain level. Options trading, while potentially lucrative, carries inherent risks. It is essential to remember that options trading is not suitable for everyone. Before venturing into this realm, it's crucial to consult with a qualified financial advisor to assess your risk tolerance and determine if options trading aligns with your financial goals. Options can be a powerful tool for experienced traders, but they can also lead to significant losses if not used wisely. Remember, education is key. In the subsequent sections, we'll delve deeper into the mechanics of the covered put strategy, understand the associated risks, and explore how it can be employed to generate income. Let's break down the covered put strategy. Imagine you're selling insurance on a house, the stock. The put buyer pays you a premium for the right to sell you the stock at a specific price, the strike price, within a certain time frame. If the stock price drops below the strike price, you must buy the stock. You need enough cash in your account to buy the shares or already own them. In return, you receive the premium up front. If the stock price stays above the strike price, you keep the premium. Now, let's talk about Greeks. Don't worry, it's not as complicated as it sounds. Greeks are just fancy names for measures that tell us how sensitive an option's price is to different factors. Two Greeks are particularly important for covered puts, delta and theta. Delta measures how much the option price is expected to move for every $1 change in the underlying stock price. A delta of negative 0.50 means that for every $1 decrease in the stock price, the option price will likely increase by $0.50. Theta, on the other hand, measures the time decay of an option. Think of it like ice melting. As time passes, the value of the option gradually decreases. A theta of negative 0.10 means that the option will lose $0.10 in value each day, assuming all else remains constant. Understanding delta and theta is crucial for managing risk and maximizing profitability in covered put trading. Let's say you're bullish on Apple, AAPL, and believe its stock price will hold steady or rise in the coming month. AAPL is currently trading at $175. You decide to sell a covered put option with a strike price of $170 expiring in 1 month. The premium you receive is $2 per share. Since each option contract represents 100 shares, the total premium collected is $200. If AAPL's price stays above $170 at expiration, you keep the $200 premium. This is your maximum profit for the trade. However, if AAPL's price drops to $165, you might be assigned the shares at $170. This means you'd buy 100 shares of AAPL at $170, even though the market price is $165. In this scenario, your total cost for the shares would be $17,000. Subtracting the $200 premium you received, your net cost basis for the shares would be $16,800. Premium collection. The income engine. The beauty of the covered put strategy lies in its potential to generate income through premium collection. By selling put options, you receive an upfront payment, the premium, which represents the time value of the option. This premium is yours to keep regardless of whether the option is exercised or not. If the stock price remains above the strike price, the option expires worthless, and you keep the entire premium as profit. Even if the stock price dips slightly below the strike price, the premium collected can help to cushion potential losses. This income-generating feature makes covered puts an attractive strategy for investors seeking consistent cash flow. However, it's important to remember that premium income doesn't come without risks. There's always the possibility of the stock price moving against your position, potentially leading to losses. Managing risk assignment and loss potential. While covered puts can be an effective income strategy, it's crucial to understand and manage the associated risks. The primary risk is assignment, which occurs when the stock price falls below the strike price and the put buyer exercises their right to sell you the shares. If assigned, you're obligated to purchase the shares at the strike price, even if it's higher than the current market price. This can result in capital losses if the stock price continues to decline. Another risk is the potential for unlimited losses if the stock price plummets. Although the premium collected provides some downside protection, it's limited to the premium amount. To mitigate these risks, it's essential to select stocks with strong fundamentals and a low probability of significant price drops. Choose strike prices that align with your risk tolerance and capital availability, and implement stop-loss orders to limit potential losses. Suitability and considerations. Covered puts are generally more suitable for investors with a neutral to bullish outlook on a particular stock or index. Those seeking income generation rather than capital appreciation. Individuals with a longer-term investment horizon. Before implementing a covered put strategy, it's crucial to consider your risk tolerance and investment goals, your understanding of options trading and the underlying asset, the potential impact of assignment on your portfolio, and the availability of sufficient capital to cover potential losses or purchase assigned shares. Advantages and disadvantages of covered puts. Advantages: income generation through premium collection, potential for capital appreciation if the stock price rises, partial downside protection due to the premium received. Defined risk, as the maximum loss is limited to the strike price minus the premium received. Disadvantages: limited profit potential capped at the premium received. Risk of assignment if the stock price falls below the strike price. Potential for unlimited losses if the stock price plummets. Opportunity cost of tying up capital that could be invested elsewhere. Conclusion: a powerful income-generating tool. The covered put strategy can be a valuable tool for investors seeking to generate income and enhance returns. By understanding the mechanics, managing risks effectively, and aligning the strategy with their investment goals, investors can potentially benefit from this versatile options approach. However, it's essential to remember that options trading involves inherent risks and is not suitable for everyone. Thorough research, education, and careful consideration are paramount before embarking on any options trading strategy. Remember, knowledge is power. By equipping yourself with a deep understanding of options and seeking guidance from qualified financial professionals, You can navigate the complexities of the market and make informed decisions that align with your financial aspirations.